Welcome to TheoTrade. This is Don Kaufman. It's September 17th, 2018. You are watching the Theo Night video. Let's start with tech is getting hammered. Specifically, I'm actually referencing the monsters of tech with just about 2 minutes and some odd seconds left in the trading day. What I want you to kind of key into is right there. What I term the monsters of tech happen to be none other than, of course, it's Facebook and it's Apple and it's Microsoft and Google and Amazon, all compiled into one kind of index, which is down again in excess of 2% today. But the reality is, in this kind of, tech getting hammered trading session, frankly, it's not what it's got my attention. What has my attention is complete and utter correlation, breakdown, correlation, chaos. The correlations that we've been looking at in markets for years are all in utter failure inside of today's trading session. And that's some of the larger standout. Now, before I get into any of these correlations to any degree in any depth, okay, just a brief look at the marketplace where you're seeing the S&P's down about 18 handles a minute to go. The Nasdaq is off by about 1.5%. The Dow is really strong on a relative basis. The Russell also kind of taking it on the chin by the tune of just over 1%. Volatility playing a very, very small role in here. Now, let's start to kind of break into this idea of, well, correlation kind of breakdown. And what that effectively means is, the first place I want to take you is once again over to the advanced decline line. If you see this, you might not even believe it. You have the S&P's down almost 20 handles with the advanced decline line, specifically at a 50-50. I happened to cover this literally last week. I was covering about, how correlations are completely out of whack. But this is the largest move we've seen yet without any correlation whatsoever. And, as a participant in the marketplace, whether you're an investor, whether you're a trader, that's neither here nor there. How can this impact you, and why should you care about this utter, displacency, if you will, of these correlations? Because, again, they're all over the place. First and foremost, what we're effectively seeing today is a rotation out of technology, okay? There is some sell-side activity also in the financials, which, again, this stuff is huge. Financials down and technology down, and yet the advanced decline line is a 50-50 at the close. What gives? There's the closing bell. Well, it's each and every day, all right? Fund managers are finding homes to put capital, and it's literally like a shell game happening at a very, very fast clip. And again, the shell game today, and if you kind of follow along here on the screen, the shell game today is obviously rotating out of specific sectors. Okay, those sectors happen to be IT, it's technology, the other sector being rotated out to of consumer discretionary. The interesting irony with that is they're rotating out of consumer discretionary. They're into consumer staples. It's a highly defensive marketplace today. So what's the problem with that? Well, the problem is, what if the music stops and we start seeing markets form their correlations again? One thing, okay, that should really resonate with you from this video is that this kind of correlation breakdown, historically speaking, although we've seen this before, we've just never really seen it, okay, to the full extent that's kind of playing out in just the last couple of trading sessions. But the way that you want to view this is, okay, it is a extraordinarily high-risk situation because any announcement, any news that comes in can immediately shift a marketplace from this 50-50 correlation, okay, to a 90-10 or even worse, to 100-0. That is, all right, historically speaking, when you see the S&Ps off by 18 points or 14 points in this case, the markets are typically in a situation where they're at least 70-30, okay? And that's with the S&Ps down 14. With the S&Ps down 20, we should prototypically see about 85-15 in terms of the advanced decline line. Again, that's with the S&Ps down 20 on a historic basis. Right now, what do you got? 50-50 with the S&Ps down 15. Again, it doesn't bode well. And what it effectively leads is risk, okay, wide open. It's one of the reasons that in this weekend's video, I was alluding to the fact if you have a decent amount of risk on right now, if you're not comfortable with that risk, hedge now or forever hold your peace. This doesn't necessarily portray, and I don't want to be kind of miscommunication on here. I don't want any misunderstandings. This doesn't necessarily portray that the marketplace is going to sell off, okay? On the contrary, right now, what you're seeing, all right, are funds trying to prop this thing up. When a leg gets kicked out, and speaking of a leg, we'll talk about Amazon for a second, especially on an intraday basis. When a leg of Amazon gets kicked out, what do? They rotate out of Amazon and all of a sudden decide Walmart's the greatest thing, or Caterpillar. See, Amazon has absolutely monumental market cap. So if you're going to pull capital from there, you're going to have to push capital into equivalency market caps to ultimately prop up the marketplace to a degree. So it makes sense, again, out of Amazon, what's ultimately getting propped up in here? You're starting to see Dow stocks that no one has wanted to touch. The entire year, no one was wanted to touch Caterpillar, right? Not even Caterpillar, okay, wants to touch Caterpillar. But this thing's off from 173, all right, all the way down to 146 on a year-to-date percentage. Its high on the year was up pretty much about 10-11%. It's effectively now still down 6%. I mean, this is a wild ride to the downside. All of a sudden now, we're buying Caterpillar. Why? Because we're rotating out of what have been some of the darlings of technology. Okay? The whole question is not, okay? It's not when the entire marketplace is going to fall apart. The question here is, what sectors do you want to be in if by chance the marketplace does fall apart, and what sectors are going to give you the best risk reward? So at this moment in time, I don't look at this and think to myself oh, this means I really, really want to short, technology, or I want to short this or that. Okay. What it comes down to is I start to, again, view the sectors themselves, and I'm looking, all right, for where I can grab the best risk reward in any given trade. Allow me to give a few examples. So one of the sectors that I have been very critical of lately happens to be the financials. Now, yes, I am carrying short positions in the financials. One of the primary reasons for that, though, is their susceptibility, okay, to this kind of correlation breakdown, and their susceptibility to risk inside right now of the bonds, with interest rates flying higher. Okay, not only haven't we seen financials going up with interest rates going up. Now, this is one of the correlation breakdowns that I'm actually referencing. If you take a look at TNX, this is interest rates. Where are interest rates? Okay, straight up, people. I mean, they've basically traded 2.8% straight shot to 3%. And, well, what is that doing for the financials? Okay, for the financials, absolutely nothing. The financials have actually headed the opposing way, which again is contrary to what we have seen historically in terms of correlations. Does this provide, okay, a bit of a trade idea for us? Absolutely. Okay, in a trade like this, I would like to short into the XLF, not necessarily short the shares of the ETF, and it's one of the reasons I built the position inside of JP Morgan, but short shares of the ETF can actually tie up a lot of capital, okay? Rather than just short the outright shares, maybe we use, okay, deep in the money puts. In this example, you're looking at about an 85 delta put that I've purchased. It's a synthetic short position inside of the XLF, okay, predicated on the fact that the correlation is really broken down substantially in the financials, okay? And at this point in time, there's a really favorable risk reward in here. Let me give you, again, kind of a quick example. Assume that the bonds right now rally back up. If the bonds rally back up, it'll actually take interest rates lower. Everybody will turn around. That is not going to be good for financials. They'll probably take the financial products a little bit lower. On the contrary, if the bonds continue to kind of break down. Well, that hasn't helped the financials either. And again, it's these types of correlations that we look at to be able to produce, again, viable trades. Now, another one that has actually helped substantially in terms of this correlation kind of breakdown has been specific to the XRT. Once again, I bring up the retailers. You can see I'm working an order in here to roll an in-out spread further out in time. Nevertheless, retail also, okay, highly interest rate sensitive. And the interesting irony here is that we've had higher interest rates lately, but the retail sector doesn't seem to be backing off by any stretch of the imagination. The other thing is the resale sector has been, up until a few weeks ago, this was the sector that everybody was rotating into. Now it's out of favor. So even if you don't like the interest rate, okay, conversation, which is fine, understand that this is no longer in favor. And the retail sector itself, it appears that this is where now they're going to rotate out of. Again, a short position here inside of the XRT. There's a lot to think about. And again, I recognize that everyone, their attention happens to be specifically on technology, or their attention is on, for example, like Amazon. But how opportunistic is something like Amazon? Listen, this thing pretty much skinned its knee right now. When you start talking about Amazon on a year-to-date percentage basis, okay, has it come off a little bit? Yeah, by the tune of about 10%. Could it come off more? Absolutely. I mean, this thing could be a debacle, even if Amazon were to sell off, okay, from here, right? Just to kind of quantify it, even if Amazon were to sell off all the way back down to the 1200 mark, that's just getting it back down to even on the entire year. Again, a little perspective in a product like this, when you start pulling up a 3-year, okay, 1,000, well, it was there not too long ago. And then we're not even looking again at a full year of data in this particular circumstance. So at this point in time, right, technology, yeah, a little sell side activity, but we can't call this yet a sell-off. It's correlations that have to take center stage, okay? And if you're curious, like, all right, well, when will we know when a real sell-off kind of grips hold? When you wake up, okay, and this advanced decline line looks more like 90-10, that it's 90 decliners, 10 advancers, you're going to know pretty quick markets are going to get serious in a hurry. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.